All right, let's switch to canola now. As we stated earlier, canola dropped almost 12 bucks today. Today was the first notice day for November futures. So, what is exactly first notice day? So, first notice day is the first day that a holder of a futures position can be assigned a delivery notice from a short position. So, the short holders assign delivery notice from the long position. So, in plain English, it's the day that the futures contract essentially stops being purely a paper trade and it starts to represent actual physical delivery. So, why would that happen? So, a couple of things. One, commercials will exit the trade to avoid delivery. So, as the contract nears the delivery period, most speculators and commercials who don't want to make or take delivery must roll or liquidate their positions. Longs who aren't prepared to accept delivery sell before the first notice day, and that surge in selling, especially in a relatively thin market like canola can be, can drive the prices down. So think of it as everyone trying to squeeze out of the same door before the warehouse operator locks the door. So another reason would be weak basis or cash market signals. That's what this chart is showing here. Let me turn my laser pointer on here. So the cash market often drives nearby futures as delivery approaches. If the physical buyers like the exporters, the crushers, the elevators are already well covered or demand is weak, such as it is in canola on the future side right now. So that means the futures will converge lower to meet the cash value. So you may have heard that the saying "cash is king." This definitely applies to this situation. The convergence can look like a sudden drop, even though it's really just the market normalizing towards the cash value. So, again, to put it in another way, let's say you're a long holder in canola and you don't want to take delivery because you know that you can go to the cash market to the farm bin and source it significantly cheaper. You'll want to pitch that long position ahead of the first notice day. So that, in my opinion, that's probably some of what is happening. Um, Also, let's talk about yield curve here a little bit because that has an impact. Obviously, these carries are really large. So the carries meaning the difference between the futures months. There is a calculation that you can do that shows how close to full commercial carry a market is trading. And canola from the November to the January was trading at full carry around 14 or 15 bucks a ton. Um, so what happens is that the at the end of the period, the market converges to cash, and we almost saw exactly the same amount of losses today in canola as we saw the carry in between the two markets. So um, just to kind of show it another way, this is the yield curve. So 1420, I think 15 or so is full carry. Even, some would calculate it as 14 or 14 and a half. We're right there. We're right at full carry from the November to the January. So now that the January will become the front month, now we look at the March and forward as indicators of how supplied the market is, and the higher supply in the marketplace, the larger these spreads will be. So now, the risk will be if nothing else changes, we may see a convergence back down on the March into the January cash price again. If nothing else is or if nothing else changes, or if all other things are considered equal. So hopefully that gives you an idea as to what may have happened in the canola market today. I mean, there was some other outside factors such as the soybean oil losses today, but I think that the first notice day here on canola, actually the first notice day on bean oil, might have been a factor as well. So that hopefully gets you caught up on canola and helps you understand what happened here at the end of October.